So I have started recording also. So we are considering the asset management or the efficiency ratios. So we shall be talking about basically how efficiently the assets are managed by the firm or used by the firms. So we shall be talking about different types of assets, and we shall be talking about the efficiency in using those assets. So let us start from the inventory. So it comes under the current asset of the firm, and we shall be talking about the inventory turnover, which is actually a very important asset management measure for the firm. So this is defined as cost of goods sold divided by the inventories. So the cost of goods sold, as if you could recall, it was the cost related to the production of those goods that come for selling in the market. So that cost per unit of the inventories. So suppose that inventory turnover happens to be, say, 2.1. So just take an example. So suppose it is 2.1. So in that sense, the company sold off or turned over the entire inventory 2.1 times during the year. So as long as the company is not running out of the stock and thereby foregoing the sales, the higher this ratio is, the more efficiently the company will be managing the inventory. Okay, so that is how the inventory turnover will be used by the firms. So next, which is based on the inventory turnover also, this is another measure which says the days sales in inventory. So it will be giving you some idea about the days that will be, or rather that will be spent on the inventories before they are going for or before they are converted into the finished goods. So days sales in inventory is defined as 365 days because we have 365 days in a year. So we are not talking about any trading days in a year. So if you have trading days, then the number will be reduced from the 365 days. So we are considering the entire year. So the days sales in inventory will be defined as 365 days divided by the inventory turnover ratio that we have computed from here. So what is meant by these days sales in inventory? Now this essentially means that suppose we are taking any fictitious value of these days sales in inventory, suppose it is 100 days. So in that case, roughly speaking, the inventory sits 100 days on average before it is sold. So alternatively, assuming we use the most recent inventory and the cost figures, it will take about roughly 100 days to work off our current inventory. Now that efficiency measure and the inventory, as we have discussed earlier, will be varying from one type of firm to other. So depending on the nature of the firm, so accordingly, we shall have to take the decision. Next that we have is the receivable turnover. So within the asset category also we have the receivables. Receivables, current receivables. So receivable turnover is defined as sales divided by the accounts receivable. Okay, so suppose once again we take some fictitious figure for that. So sales by accounts receivable, say it is just 10. The receivable turnover value is 10. So loosely speaking, then the company has collected its outstanding credit accounts and lent the money again. What I have told you, the value 10 perhaps. So 10 times during the year. So if the value is 10, then the outstanding credit accounts will be collected and the money will be lent again 10 times during this particular year. Now, as is shown in any financial analysis, financial performance analysis, the days sales in receivable will be more appropriate or it will be more meaningful for our analysis. So it is just like days sales in inventory. So days sales in receivable will be just 365 days divided by the receivable turnover. So this, once again, suppose it is 30 days. So on average, we collect on our credit sales in 30 days. So this is called the average collection period also, right? So this is the number of days the company will be requiring to recollect all the credit sales. So of course, the lower the better. Now, apart from these ratios, there is another ratio which is most widely used, and probably it is more what should I say? The investors can understand this ratio more easily than the other ratios. For example, inventory turnover or the receivable turnover. So this is called the total asset turnover. So this gives us the total sales divided by the total asset. So sales per unit of the total asset. So in that case, we are talking about the total asset. And once again, the same problem of defining the total asset will be there. So you have the fixed asset and the current asset. So whenever you are comparing the different assets, then you should be very, very careful in using the total asset turnover. Otherwise, it is the most commonly used indicator. And of course, higher the better. So if the asset turnover ratio is higher, then the firm is efficiently managing its entire amount of resources. So the first one and the third one will be related to two special type of assets or two specific type of assets, whereas this total asset turnover ratio will be based on the entire amount of asset. So these are the five management or efficiency measures that we can consider when we shall be talking about the health of the firm. Now the fourth one, the profitability measure, and mostly the investors will be interested in this profitability measure because profit is a concept that will be easily understood by the investors. So they are more interested in profit. At the same time, the profit will be a part of the profit will be paid out as the dividend. Therefore, the investors will be more interested in profit. And if you speak in terms of profit, then the investors can better understand your position. So what are the profitability measures? So as I have discussed earlier, I'll be talking about the actual profitability measures and the perceived measures also. So the actual profitability measures that are most commonly used are the gross profit margin and the net profit margin. So this gross profit margin is the earning before interest and taxes per unit of sales. This earning before interest and taxes, if you could recall, will be coming from the income statement. So it is the total operating revenue minus all kinds of costs plus the any other income. So, yeah, so that is EBIT by sales, and higher the better. Now, instead of relying too much on the gross profit margin, it is often better to consider the net profit margin also, because the gross profit margin may be very high, but if you go back to your income statement, then you will find that the gross profit margin EBIT may be high, but if the firm is relying too much on the debt financing or financial leverages, then interest expenses would be too high and earning before, and if the taxes are too high, then of course the net profit will be low. Now, this will be a common phenomenon during the periods of crisis. Therefore, when you are talking in terms of a crisis, or when you are analyzing the position of a firm in a crisis, so be very careful not to consider the gross profit margin only, but consider the net profit margin also, because it is because of these interest expenses there may be partial or complete bankruptcy. So gross profit margin may be very high, but net profit margin may be low, so that the equity holders may be getting nothing. First of all, dividends will be zero and the retained earning will be zero, so that there will be relatively less or even no provision for future investment. So these two are the most widely used margin. Okay. So the third one, this is called the EBITDA. So as I have discussed earlier, it is just like the cash coverage. It is similar to the cash coverage ratio. So EBITDA plus depreciation plus all kind of amortization. So that gives us the cash, the total cash position for the company, and so probably that will be giving you a better measure of profitability. So you are just widening your idea of the amount of earning of the firm. Now, the problem is often this gross profit margin and the net profit margins are widely used in the context of the financial analysis, but unfortunately these are not treated as the true measure of profitability. So why that is so? Because whenever we are talking about this ratio, say gross profit margin, so here you are expressing EBIT in terms of the sales. So what proportion of sales, the total operating revenue, will be converted into EBIT? Similarly here, what proportion of the total sales will be converted into the profit after taxes or net profit? But the point is that if the cost is manipulated, then in that case, your costs may be overestimated or underestimated. So in that case, the gross profit margin or the net profit margin may not give you the true measure of profitability. So costs may be inflated, costs may be overestimated, costs may be over-reported also. Now, over-reporting may be a result of overestimation. So they may not be. It may not be the case that the firms are just willing to over-report the costs. It may not be the case, or under-report the cost so that the profit turns out to be a bigger amount, but that may not be done willingly. So there may be some problem in estimation of the cost, so that profit may be reported as excessively high, whereas the true picture is not like that. So therefore, instead of relying too much on the gross profit or net profit margin, often it is said that it is better to depend on some measures which give you idea about the return on asset. Now, why it is important to consider the return on the asset? Because the assets are investments of the firm. So if a firm is truly profitable, then its assets should be more profitable or more paying. It should pay you more if your assets are profitable. Otherwise, you have not chosen a very good asset. So that is why it is not giving you much return. So as pointed out by Ross et al. And others also, Wild et al., so they have always considered a parallel set of indicators that is based on, or that are based on, the return on assets rather than the simple gross profit or the net profit margin. So once again, if you consider the return on asset, you will be having two types of returns there. The gross return on asset, which is EBIT by total asset. Now, the difference between these two is that in the first case, we are showing how much of sales is being converted into profit. And here we are saying how much of profit is generated per unit of the total asset. But once again, we should be very careful because this involves total asset. So comparing the firms may not be very easy. So whenever you are taking decision on the basis of return on asset, be very, very careful about the nature of the firm. So the gross return on asset and the net return on asset. Now come to the return on equity. Because equity holders are owners, as you know, so they may be interested in the efficiency of the equity. Right. So this return on equity is a measure of how the stockholders fared during the particular year. Because benefiting the shareholder may be our goal. Now, once again, there is a difference between, as I have pointed earlier, that there is a difference between the stakeholder theory and the stockholder theory. So suppose we are going by the stockholder theory, so that we are not talking about the responsible investment right now. So it is very important to benefit the shareholders. So if that is our objective, then return on equity will be a true measure. So this is defined as profit after tax by total equity, or net profit generated per unit of the total stockholders equity. So this return on equity will be very important for the equity holders, right? So if you have the all equity financed firm, then the return on asset will be exactly equal to the return on equity, because assets are exactly equal to equity. But if you have a financial leverage, then of course there will be a discrepancy between these two, right? So these are the actual profitability measures. Now we shall be considering two other ratios also, the payout ratio and the retention ratio. Now I was talking about the importance of the dividend payout and retention ratios. What are its significances for the investment strategies for the firm, particularly during the periods of credit rationing or the period of crisis. So this payout ratio is defined as dividend per unit of profit after taxes. So how much of total net profit is being distributed as dividend? And this retention ratio is nothing but 1 minus the payout ratio. So higher the payout ratio, the lower will be the retention ratio. Now, once again, higher payout ratio may be good. So in that case, the investors will be attracted. But at the same time, higher payout ratio may not be that good, because the retention ratio is lower, so that the firm is not keeping money for future investment. So possibly the firm is not having any perceived growth opportunity. Now, once again, I'm talking in terms of perception, not in terms of reality. So perceived growth opportunity may be lower for the firm, right? So once again, payout ratio then 0 may not be always a bad thing, because as I have discussed earlier, the knowledge-based firm, the technology firms, the biotechnology firm, the firms that are based on research and development, they often pay 0 dividends. So that payout ratio will be 0 for them. But still, they are having lots and lots of investors, so that their prices are excessively higher in the stock market. So lower payout ratio is not always a very bad thing. So whenever you are taking a decision on the basis of the profitability measure, be absolutely sure to compare the actual profitability with the perceived profitability, and just try to find out whether the perceived profitability transforms itself into the actual profitability. So there are certain other relationships that we may be considering very briefly. Okay, so the return on equity, which is our profitability measure, as we have seen from here, and since we are talking about the stockholders' benefit, then this return on equity will be very important. Now, this return on equity, by simple manipulation, you can show that this return on equity can be expressed as the product of 3 ratios that have already been discussed. So net income into sales, net income by sales into sales by total asset, into total asset by total equity. So if you simplify, you will find it as net income by total equity. So net income by sales, this is nothing but our net profit margin. Sales by total asset, our total average turnover ratio. Total asset by total equity is our equity multiplier. So from here, we get a very important result. Return on equity, or the benefit of the stockholders, will depend on 3 things, right? So if our target is benefiting the stockholders, then we should be aware, or we should be very, very careful about three things. One is the operating efficiency, the asset use efficiency, and the financial leverage, right? So operating efficiency or the profitability, of course, the net profit margin, the asset use efficiency, total asset turnover, and the financial leverage. So these three things will be very, very important if you are talking about the stockholders benefit or the theory of stockholders benefit. But of course, if you are considering the, as is suggested by Freeman, if you are talking about the stakeholders theory, then these three will not be efficient. With it, you must have some sustainability concepts. So some social responsibility should be there. Okay, so from the point of view of the firm also, from the point of view of the investor also. Okay, so now we have considered these four areas. Now, before we move on to the fifth area, which is the value or the valuation of the firm in the stock market, let us now try to find out, or rather, let's see whether we can find out how much external financing will be needed by a firm, right? So we shall be using our data to show how the external, or by how much external financing will be needed by some fictitious firm. Okay. So we are considering our typical firm. We assume that every item will change by the same proportion. Now, you can do the same analysis using a scenario analysis or using a sensitivity analysis, but here I am not talking about the sensitivity analysis. I'll be taking only one value and then I shall be considering only one change. But if you talk about the sensitivity analysis, then you can have a series of such values that will be changing or that will be generated in response to a given change, right? But here we shall be talking about only two cases, the initial case and case one, where there will be some changes, right? So costs will be changing by some proportion. But whatever be the case, we shall be assumed that every item will be changing by the same proportion. Now, if I say that, that is not a very realistic assumption. Yes, of course, that is not a very realistic assumption. But once you have the idea of how to find out whether external financing is needed or not, then you can always manipulate and you can have always more reliable or more rational type of data so that you can make the proportions vary. So now we assume that there is a sales forecast. So there will be some change in the sales. So accordingly, the costs will also be changed. As I have mentioned earlier, this could be done using a scenario analysis or a sensitivity analysis. Now the changed income will be calculated and the firm has a payout ratio and a retention ratio. Now we shall be assuming that this payout ratio and the retention ratio will not be changing over time. So once again, you may accuse me to be of unrealistic in terms of accounting sense, okay, but that may be unrealistic. But of course, once you know how to do it, you can always change your payout ratio and the retention ratio. Okay, so thus you will be having some projected net income, payout, and the projected retained earning may be estimated. Okay, now the point is, on the balance sheet, some assets will be varying directly with sales and some will be not. So along with this, we should have the balance sheet. So we must have the balance sheet as well as the profit and loss account. So the ratio of total asset to sales is called the capital intensity ratio. So for each firm, there will be a capital intensity ratio, which is defined as the ratio of total asset to the total sales. So we now assume, once again, maybe unrealistically, that this ratio is constant. So what does that mean? That means that if you project some increase in the sales, then that will increase the assets proportionately. But of course, you can assume that this capital intensity ratio will be varying and your change in asset following an increase in sales will be changed accordingly. So that will be just making our life more complicated. So that is why I am not going to do that. But you as an investor should be doing that. On the liability side, of course, some would increase spontaneously with sales. For example, accounts payable, that will be increasing with sales, but some would not, like notes payable, because notes payable will be like the promissory notes. So I have taken some loan and within a short period of time I'll be paying some interest and I'll be paying back the principal amount. So that will not be varying with the sales, but accounts payable definitely will be varying with that. Okay, so now I'll be sharing with you an Excel sheet. So please give me some time for that, where we shall be making the changes. Now, is this visible? Is this visible?
Yes, ma'am.
Yes, ma'am.
What is the name of the Excel sheet? Workshop.
Yes, ma'am.
Okay, okay. Okay, fine. Okay, so that is the Excel that, or the data that I'm trying to share with you. So we have one fictitious company, abc.inc. So that company in the current, so as I have mentioned earlier, so we shall be having only a current period and only a projected period. So that's a projection for only one future period. But if you are interested, you can of course go for more than one. Okay. So what happens in the sales in the current period? The sales is 1,500. So I'm not mentioning the unit of money. So it could be anything. It could be rupee crore. It could be dollar. It could be $1 million, whatever. So 1,500. Cost is 900. Okay. Cost is 900, which is actually 80% of the total sales. So if you find out, so the initial cost is 900. Okay. So you are calculating the taxable income. So the taxable income, so sales minus all kinds of costs. So it's a very simplistic setup. So within this cost, you have everything. So taxable income, the sales minus the cost. We have a tax of 34%. That's once again, we're assuming it to be 34%. So that is the tax. And you have a net income. Okay? So the net income is taxable income minus the taxes. So this company has a payout ratio of 1/4 and the retention ratio of 3/4. Of course, you can always change that. Therefore, you can calculate the retained earning and the payout, retained earning and the dividend from here. So this dividend is nothing but this net income times this payout ratio. as is mentioned here. And the retained earning is nothing but this net income divided by or multiplied by the retention ratio. So this is the current projection, current scenario. Now come to the balance sheet. Okay. So in the balance sheet, so this is a very simplified form of the balance sheet. You may or may not agree with that, but this is sufficient for our analysis. So once you are comfortable with this, you can always consider some other complicated balance sheet and you can work on it. So the current asset, cash 180, and the percentage of sales is 12. Okay. So what is our total sales then? It is 1,500 and our total cash is 180. So the percentage cash as a percentage of sales will be 12%. Next, it is the accounts receivable. The accounts receivable is 450. This 450, then we consider it as a percentage of sales. Similarly, inventory as a percentage of sales. Then we try to calculate the total current asset, which is nothing but the sum of these three items. So this is our total current asset. Within the fixed asset, once again, we are assuming that there is no intangible asset or any other complication, so that we have net plant and equipment only. Now, this structure is taken from the Corporate Finance, the book Corporate Finance by Ross et al. So this is taken from the 11th edition, but the data is different. So that is why I have not given the reference here, but it is from Ross, Westerfield, and Jeff, plus Jordan and Kakani. So that is the 11th edition of the Corporate Finance. So if you are interested, you can also look into that. So now the total asset, which is nothing but the total current asset plus the total fixed asset. Now come to the liability side, liability plus equity. Now, as we have mentioned earlier, okay, first of all, consider the items, accounts payable, notes payable, and then total current liability, long-term debt. Within the equity, you have common stock and surplus. So these two are merged, retained earning, and then you have total equity. Therefore, the total equity plus liability is 3480, which is equal to total asset. Now, theoretically, accounts payable will be only varying with sales, right? So as I have mentioned earlier, not the others. So we are assuming that accounts payable are varying with sales. So if you are talking about the initial stage, then initial projection, then of course the this is the projection and these are the percentage of sales. Okay. So now come to the perceived future. So the sales is estimated to rise. So sales is increased by 25%. Right? Sales will be estimated by then 1875, which is the original sales, plus 25% increase. Now we assume that costs will be 80% of this sales. Right? Now all these are hypothetical figures, as I have pointed out. You can always change your figure, but don't ask me the question why have you taken it to be 80%. These are all hypothetical figures. You can always change these figures. Okay, so in that case, you just calculate the taxable income. So that is your tax, your net income, and now your dividends and the retained earnings have changed, right? The dividends and the retained earnings have changed, and depending on the payout ratio and the constant retention ratio. Okay, so please excuse me for 2 minutes. I'll be just coming back. Please excuse me. Okay. Yeah, so sorry for the interruption. I'm back. Is it visible?
Yes, ma'am.
Yes, ma'am. Yes, ma'am.
Okay, okay,
Visible.
okay, okay. Okay, so now we have assumed then so that is our projected scenario. But once again, we are assuming that even in the projected scenario, the payout ratio and the retention ratio will be remaining unchanged. But of course, you may change those assumptions so that in this year, your total payout and total retention may be changing. Okay, so now come to the changes. Okay, so then how could you find out the cash then? Initially, your cash was
Hello, ma'am.
Hello?
Ma'am, the slide has been changed. Like now the title is data company.
Okay, 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 okay. Okay. Visible? Okay, so is it workshop?
Yes, ma'am.
Excel
Now it's okay.
Okay, okay,
Yes.
okay, fine, fine. Okay, so now just tell me, how to find out the cash then in the projected scenario? Who is going to answer? How to find out the cash? And of course, the formula is given here. So logically, how to find out the cash? Who is going to answer?
Ma'am,
Yes.
maybe we'll still keep the cash as 12% of sales.
Exactly. Very good. Who are you, please? Because I can't see the.
Ma'am, Priyanka.
Okay. Okay. That's really a good answer. Okay. So you will have to maintain this percentage of sales, right? So here the percentage of sales will be varying. So accordingly, if the sales are changing, then these values will also be changing depending on the percentage of sales. So that is why you say, how could you find out the changed cash? It is what is C6? It is the sales under the projected scenario times what is our K6? This is the 12% of sales, right? So that is why you have calculated the cash to be 225. So there has been a change in the cash. So by how much cash has changed? Initially it was 120, now it is 225. So it is just the difference between 225 and 180, right? So in the balance sheet, there are certain things that are changing with the change in these projections. Okay. The accounts receivables, they are also tied to the sales. So in the same way, we have calculated the accounts receivable here. So it has also increased and it has changed by this much. Inventory tied to sales, that is why it has increased. That is the percentage of change. Total current asset, of course, it is going to increase, and then this is the percentage of change. So in that way, we have calculated the change in the asset side. And if you consider
Ma'am, can't hear you.
I hope ma'am is facing some technical difficulties. So request to the participants, be patient, ma'am will come back soon.
Hi, my name is Indra Ray. I'm Gagori's colleague. It is clear, as Somo Saha has pointed out, it is clear Gagori has some technical problems. Clearly, possibly she just lost her internet connection. Let's just wait for a while. She should come back. May I just request someone, Ayush Mitro? Sorry, Ayush Gupta. Ayush Ranjan Gupta, are you here?
Yes, sir. Yes, sir.
আয়ুষ, if you have Gagori's phone number, তুমি ওনাকে একটা প্লিজ মেসেজ পাঠিয়ে দেবে।
হ্যাঁ স্যার, ফোন করছি।
জাস্ট একটা মেসেজ পাঠিয়ে দাও, ফোন করলে বিরক্ত হতে পারে। জাস্ট এমনি টেক্সট মেসেজ, হোয়াটসঅ্যাপ না, কারণ ইন্টারনেটই ডাউন হচ্ছে।
Calling her, not an issue.
Oh, okay. Oh, very good. Thank you so much. I don't know you at all, so that's why I asked Ayush. Okay, thank you. Let's just wait. I think she'll be back very soon. Thank you.
Just had a talk with ma'am. She's facing some technical difficulties. So she will join within few minutes.
I request Dr. Navratna to. Yes, ma'am. Yes, ma'am. Yes, ma'am. I'm trying to share my PPT.
Please be patient. Ma'am will join soon. She's facing some technical difficulties. I had a talk just now. She will come back.
I'm sorry for the interruption. I am back once again. So let me first start the recording. Okay, it's going on. Okay, it's going on. Okay, so is it visible?
Yes, it's good now, Gaguri. Carry on.
Okay. Okay, so from here we have assumed that or rather we have calculated that the firm will be requiring some external financing. So we can explain the situation in terms of a diagram also. So let me go back to my PPT once again. Okay, so this is the projected addition to the retained earning. Now, why this retained earning is important? So this diagram is once again from Ross et al., the 11th edition, 2018 version. So the projected growth in sales is shown on the horizontal axis, and the assets, needs, and the retained earning, these two are shown on the vertical axis. So here we have two lines, right? The projected addition to the retained earning, we are assuming that the retained earning will be increasing, of course, and the ratio is not increasing, but since the sales are increasing, given the ratio, the projected, there will be projected addition to retained earning also. And there will be an increase in asset needed, because in order to produce more sales, you will be needing more assets. Therefore, this line and these two lines will be cutting at this point. So this is the point where the projected addition to retained earning will be exactly equal to the increase in the asset needed. From here, as you can show that the projected addition to retained earning line is relatively flatter than the increase in the asset needed. Therefore, for the same amount of increase in the projected growth in sales, the addition to retained earning will be lesser than the increase in the asset needed. Now, this line may have a higher slope if you could change the retention ratio also. So your projected earning is increasing and your projected sales are increasing, and at the same time you are just increasing your retention ratio. But here we are not assuming that. So this is the point where there will be no external financing will be required. Now, this will be leading to some more important indicators that we shall be talking about later on. And these two will be very important for evaluating the firm's health. So this is the range. In this range, the external financing needed will be positive, because clearly the increase in asset needed is more than the projected addition to the retained earning. Therefore, the firm will be requiring more external financing. And this is the range where the external financing, EFN, is less than 0. Therefore, the firm has enough surplus. So in this way, you can always calculate the external financing needed. Now, suppose now how will that be relevant for calculating the financial health of the firm? Now, these are all theories. So how could you relate that? That is very important, as I am continuously emphasizing on that. Now, suppose you find that EFN to be greater than 0, and it is a near crisis situation in the context of the economy itself. So there may be some paucity of the funds. The traditional financiers, the traditional financial institutions may not be ready to lend money to the firms. Once again, as I was discussing in the last session, the situation may be different for the large firms and the small firms, right? The large firms may get the loans very quickly and very easily, whereas the small firms may not get. So suppose you get the situation like that, EFN is greater than 0. So in that case, EFN is greater than 0, but there is a paucity of external financing supply. So what will happen then? The firm will be, otherwise the firm is, of course, the firm is doing good, but even during a period of crisis, it is projecting a growth in itself, but given the situation in the economy, it may not be possible for the firm to find out external financing, right? So in that case, there will be a problem for the firms. Okay. Now, from here, we can actually consider two other very important growth rates. The one is called the internal growth rate, and the other will be called the sustainable growth rate. Now, this internal growth rate is the maximum growth rate that can be achieved without any external financing. So suppose the firm is not going for any kind of external financing. It has enough money, or rather it is trying to have enough money so that it can always finance its new projects with its own money. So in that case, it will have to grow at a certain rate, because it will have to generate enough retained earning so as to be able to finance all its projected sales through the internal financing. So once again, we have that diagram that we considered earlier. So this is the point that we are interested in. So here is the point where EFN is equal to 0. So that means in order to reach that particular point, the firm will have to have a certain growth rate, which is called the internal growth rate. This internal growth rate is defined as return on asset into the retention ratio divided by 1 minus return on asset into retention ratio. So return on asset is actually the amount or the return that you are getting from the initial investment, and of that return you are saving something. How much you are saving? ROA into the retention ratio. And in order to find out the growth rate, that has to be divided by 1 minus that proportion. So that gives you the internal growth rate. So given a data, you can always find out the internal growth rate. So whether it is sufficient for the firm to achieve that or not. So for that, what is important, most important, not the retention ratio, of course, it is the ROA. Suppose your ROA is very low, then you will have to have a very high retention ratio to achieve this internal growth rate. But if your ROA is quite high, then probably your retention ratio may not be that high. Okay, so that is how the internal growth rate is defined. Now, the second type of growth rate that is very useful in this context is called the sustainable growth rate. Now, the sustainable growth rate is defined as the sustainable growth rate is the maximum growth rate that a firm can achieve with no external equity financing. So there is a difference between the internal growth rate and the sustainable growth rate. What's the difference? The difference is that in the internal growth rate, the firm is going for no external financing of any kind. And here the firm can achieve with no external equity financing. So it will be using its own equity financing in order to finance its new projects. Okay. So it is not changing its overall financial leverage, because if it is not changing its level of equity, it is not changing its level of debt also, because debt plus equity is always 100%. So how could you find out the sustainable growth rate? So this is a very simple arithmetic. So earning next year will be equal to earning this year plus something. Now from where this plus something comes? A portion of the earning of this year will be reinvested further, and that reinvestment will be fetching some return. Therefore, earning next year will be equal to earning this year plus the return from the investment that is being accrued by the retained earning, of course. So, this return on investment is written like this: retained earning this year, so this is going for further investment, into the return on the retained earning. So, this is the rate of return on this investment. So just a simple manipulation, we are dividing both sides by earning this year, provided of course with the assumption that earning this year is not 0. If earning this year is 0, so in that case, you just cannot use this. Okay, so just simple manipulation: retained earning this year into return on retained earning. So come to the right hand side, this part becomes retention ratio. We have taken the one to the left hand side, so that makes it the growth rate. It is nothing but earning next year minus earning this year by earning this year, so it's the growth rate. And here you have the retention ratio times the return on retained earning. Now how to get some estimate on the return on retained earning? So you will have to have some proxy for return on retained earning. So since the firm is not going for any external equity financing, it will be financed with the existing equity. Therefore, the return on equity may be taken as a proxy of the return on retained earning. Therefore, the growth rate turns out to be the product of retention ratio and the return on equity. So therefore, we have come to another very important result. So this is the sustainable growth rate for a firm. That's very important. You can compare you can calculate the sustainable growth rates, and then you can compare the sustainable growth rates for the different firms, and in order to find out the viability of your investment. So this is depending on 4 very important things: the profit margin, the dividend policy, the financial leverage, and efficiency. Now the dividend policy from here is clear because there is retained earnings. So if the firm is following a very friendly dividend policy, so that the equity holders will be getting higher dividend, then the retention ratio will be lower, so that this part is related to the dividend policy. But from where these 3 things are coming: the profit margin, financial leverage, and the efficiency. Now in one of our earlier slides, we have shown this, so that ROE is affected by profitability, efficiency, and financial leverage. So that is why the sustainable growth rate will be depending on these 4 things. Therefore, if you are considering a firm, then if these 4 areas are really very strong, then the firm will be having a higher sustainable growth rate, right? So that is how you can actually consider the different types of firms of different nature in order to make some investment decision. So up to this point, we have considered the indicators that are not based on the valuation of the stock market. Now, the same firm will be going for the valuation in the stock market so that its stocks will be sold at a price. Now, if we go back to our finance growth lectures once again, then there is some literature which says that if a firm is fundamentally good or fundamentally sound, then its price should be high. So the idea is the real sector and the financial sector should be strongly interconnected so that fundamentally strong firms will be highly valued in the stock market. And the reverse is also true. Therefore, just by looking at the stock prices, you should be able to find out whether, or you should be able to comment on the firm's financial or fundamental health, right? Now, so far it sounds good. So the stock market the stock prices will be one of the very important indicator, or it may be a sufficient indicator to look at to identify the viability of investment. But unfortunately, that is not. The stock market prices are determined by many other factors apart from the economic factors. Now, if you go through the literature, you will find that there are so many factors which will be affecting the stock market prices. Even if you would go through the papers published in Journal of Finance, you will find that there will be even a sunshine effect, so that on a cloudy day, the investors will not be interested to invest in the stock market, whereas in a sunny day, the investors will be interested, right? So investment may be significantly increasing at the end of the month. It may be increasing during the festival period. So there are so many times. So it will be depending on social, political, and many other factors, sociological, and even on gossip and the rumors. Therefore, market price, although it is the first important indicator of value, it should not be relied upon too much, because market prices, the real sector, financial sector nexus is often quite weak in the context of different countries. So what are the other indicators of value then? The market capitalization. So that gives that is one of other indicator of the size of the firm in the stock market. So what is market capitalization? Market capitalization is the market price times the number of shares outstanding in the market. Now, this market capitalization is very important concept, because this valuation, this gives us a value of the firm. So if you talk about any index in the stock market, be it a market index, be it a sectoral index, be it a special type of index, then all the index are based on the market capitalization. The weights are market capitalization. So what is our idea then? If a firm is valuable, then its market capitalization should be higher and its market prices should be higher. But once again, the same problem remains, because the market prices may not reflect the true fundamentals. Okay. Now now before we move on to the market to book value ratio, let us first of all consider the price earning ratio. Is it visible? Can you hear me?
Yes, ma'am.
Can you hear me? Actually,
Yes, we can hear you, Gagori.
Okay, so actually Ayush has sent me a message asking whether my net is off or not, but I think it's okay. Okay, so probably.
No, that message was sent perhaps when you were having problems.
Okay, so I have received the message right now. Okay. Okay, so I'm once again going back.
It looks good. The slide we are on now has a title value, and you have market price and so on.
Okay.
Yeah.
Okay.
Carry on.
Okay, so let us now move on to before we move on to the market to book value ratio, it is better to consider the price earning ratio first, and then market to book value ratio will bear the similar understanding or similar analysis. Okay, so the price earning ratio is nothing but the market price divided by the earning per share. So net profit per share, earning per share. So this particular indicator has two sides at the same time. So the price reflects the stock market valuation, whereas the earning per share will reflect the fundamental activity of the firm, because it is based on the net profit, right? So if the price earning ratio is exactly equal to 1, then what does that mean? That means that the stock market has been perfectly able to estimate the true potential of the firm in the market. So the price earning ratio is exactly equal to 1, and this firm is fairly priced, exactly fairly priced. But as I have mentioned earlier, it is very difficult to find out a firm which is fairly priced. So either the price earning ratio is greater than 1 or the price earning ratio is less than 1. Now, price earning ratio greater than 1 will ideally mean that the market price is greater than the earning per share. Therefore, the stock market has overestimated the true potential of the stock of the firm. Therefore, probably a bubble has been formed in the market. Once again, I'll not be making any strong statement. I'll not be saying that a bubble has been formed. I'll rather say that probably a bubble has been formed in the market. Now the point is, price earning ratio greater than 1, which is often expressed as stocks selling at multiples, does not necessarily mean that the prices of the stocks are not fairly priced. The point is that often some of the stocks will be coming with the growth opportunity. So in this context, we can distinguish between different types of stocks. We can have growth stocks, we can have cyclical stocks, value stocks, and so on. There may be some other definitions, but these three will be sufficient for our analysis. So what is a cyclical stock? The cyclical stocks are those stocks whose prices will depend on the cycles of the economy. So each economy will be having some phases of business cycle. So when the economy is recovering or when it is reaching the boom, then the prices will be rising. And when the economy is in recession or when it is in slump, then the prices will be falling or it will be hitting its minimum. So these are basically the old economy stocks. These are the cyclical stocks. Now the value stocks are those stocks for which the prices will be reflecting the fundamentals. Now along with this, there will be a separate group of stocks which are called the growth stocks. The growth stocks are those stocks where the underlying firms will be having tremendous growth opportunity. It may be technology-based stocks. Right now, these are the green stocks. They are having tremendous growth opportunity compared to the gray or the other stocks. It may be biotechnology stocks, any other knowledge-based stocks. So, the growth stocks. Now, the growth stocks, yes?
Price earning ratio. In macroeconomics, when the price is divided by any variable, it becomes the
market price divided by the earning per share. Market price per share by earning per share.
Okay.
Where earning is the net profit. Okay.
Okay. Suppose earning divided by the price.
Earning divided by price, that is called earning yield. So this is just the opposite of price earning ratio.
So it becomes the real earning as the wages divided by prices. It becomes the real wages. So
Real wages? No, these are not real wages.
no, when the nominal wages divided by price, it becomes the real wages.
That is in terms of wages.
But
Right.
here, if you suppose earning
Right.
divided by price.
Earning divided by price. So you are trying to explain that as real earning.
Yes, ma'am.
Okay, so actually the term is not real earning. It is defined as earning yield. If you go through I'll be showing you one balance sheet and one profit and loss account. You will find that there will be one entry which is called earning yield. So earning yield is just the opposite of, there's a reverse of price earning ratio. It is not called real earning ratio, but the idea is same. What you are talking about is true in conceptually, but the term is different. Okay, it is not called real earning ratio. Okay, is that clear? Okay. Now, so we were talking about the growth stocks. So the growth stocks will be coming with tremendous profit, tremendous growth potential. Now, now all the individuals are rational. A risk-averse individual is also rational. A speculator individual is also rational. But the rationality, the extent of rationality or definition of rationality will be differing. So if you are purchasing something, then you must pay a price for that. Nothing is free in this world. So often we go to the supermarket and we say that if you purchase 2 things and then the third comes as a free. Don't get fooled with all these assertions, because nothing is free in this world. So if a stock comes with growth opportunity and if you are interested to purchase that, then you must pay a price for that. So you are purchasing the growth opportunity with it. So the price of a growth stock should not match, should never match. And once again, right now I'm making a strong statement, should never match with the earning per share. This cannot be. So for the growth stocks, price earning ratio has to be greater than 1. But here lies the problem. What is meant by greater than 1? Where is the limit? It may be 10, it may be 20, it may be 100, it may be 1,000, it may be million. Everything is greater than 1. So where is the limit? Now, if you go through the literature on financial economics, you will find that there are so many works by Shiller, Siegel, they tried to point out that the price earning ratio should be around 33 for the stocks. Now, why this benchmark of 33? Because during the period of Great Depression of 1929-30, in the financial market, the stocks were, the price earning ratio of the stocks was as high as 33. So therefore, that was taken to be a benchmark, 33. But that was much before the current period of IT revolution and the knowledge-based new economy in which we are now residing. So now, if you have so many knowledge-based stocks, then this price earning ratio of 33 may not be a ceiling. Once again, if you go back to the periods of IT revolution, you could find that the stocks were selling at multiples and the price earning ratios were as high as, say, 100, 500. So where is the limit? And when the analysts, the fundamental investors, rational investors were trying to emphasize that this cannot be done. So price earning ratio cannot be this much high. But there was the assertion that this is not a bubble. This is not a high valuation. This difference is justified by the growth opportunity, the increased growth opportunity, and the traditional asset pricing theory will fail to estimate the true growth potential or the true valuation of the growth stocks. And the result was clearly visible. There was a crash. So our problem is, for the growth stock, we concede that the price earning ratio will be greater than 1. But where is the limit? Should it be 50? Should it be 500? At the same time, it should vary from farm to farm. Once again, I'm going back to the period of IT revolution. Then Infosys was selling at 500, at a price earning ratio of 500. It was selling at multiple. At the same time, RAM Informatics, Polaris Softwares, they were also selling at a price earning ratio of say 800, 900 and so on. Now, how could you justify that? Infosys was a good firm. It was having a strong fundamental. But even then, you cannot justify the price earning ratio, that high price earning ratio. But what is the justification of having RAM Informatics or Polaris Software to have a higher price earning ratio compared to Infosys? So this is nothing but the sheer speculation. And this speculation, or what Shiller tried to mention it as irrational exuberance, were coming from the assertions from the media. And even today, we are having the same type of assertions, not for the IT stocks, but for the green stocks also. So everybody is emphasizing on the green stocks. But the point is that the green stocks, once again, I'll be showing that probably tomorrow with an example, that the green stocks are subject to intrinsic bubble formation. I'll be talking about the bubbles in the next class. But you should find out some way to justify the higher price earning ratio. So you just cannot say that, okay, if the growth rate, this is a growth stock, so it should sell at multiple. So whatever price earning ratio it has, it is justified. So this is not done. So you will have to have some indicators also. You can find out the sustainable growth rate then. You can find out the internal growth rate. You can find out the net present value of the growth opportunity also. Now that is also a part of the stock evaluation, but that is, since that is not on the financial ratio, so I'll not be going into that. So I'll show you how to find out the possibility of default of a firm. So whenever you are depending on the price earning ratio, so just by looking at the ratio, it is very difficult to comment anything. So a price earning ratio lower does not necessarily mean that the firm is good, and a price earning ratio very high does not necessarily mean that the firm is really, really bad. Now, the same idea is defining the market to book value ratio. The market to book value ratio is defined as market price per share, or the share price actually, divided by the book value per share of the firm. Now, what is the book value? Book value consists of three things: the stockholders' equity, the reserve and surplus or the capital surplus, and the retained earning. So these are the three things that will be there in the book value per share. So this book value per share gives the firm's actual investment potential. And what about the market prices? Market prices will be giving us the perceived growth potential of the firm. Why it is perceived growth potential? Because prices reflect the market's sentiment. So if market feels that you should be highly valued, you will be highly valued. So your prices will be high. It may be the case that you are not fundamentally strong, but still you have a very high price. So the market price reflects the market sentiment, and it gives you the perceived growth opportunity of the firm. Whereas the book value per share, as the definition suggests, will be giving you the actual or the true investment potential. So if the market to book value ratio is exactly equal to 1, the perception matches the reality, and there is no problem. But if the ratio is not equal to 1, then the perception does not match the reality. Say, for example, the ratio is greater than 1. So the market price is more than the book value per share, so that the stock market has overestimated your true investment potential. What happens if the ratio is less than 1? The ratio less than 1 means the market is underestimating your investment potential. Now, once again, if the market to book value ratio is high, then you still have the same logic as we had when the price earning ratio was greater than 1. So maybe the stock is a growth stock, so that the growth rate is quite high and that is being reflected in the market prices. So you should pay that high market to book value ratio is justified. Right. But once again, you should be very, very careful while using these indicators. Right. Now, so these are the main indicators that you can talk about while you are evaluating the financial health of a firm. So I'll be stopping here today because I have only 4 minutes to go. I'll be stopping here on the next day, and I'll be taking some questions if you have anything to clarify. And on the next day, that is the last day on the workshop, I'll be dealing with some data and I'll show you some ways to evaluate how could you use this data in order to evaluate the investment potential of a particular firm. So I'll be using some instruments. Very briefly, I'll be not going into the details of econometrics because that might be the scope of some other workshop. So I'll not be going into the details of the econometrics, but I'll be showing you different ways in which you can use Excel or at least views to find out the investment potential of the firms. Okay, so I'll be stopping here today. Is there any question? So if you have any question, you can clarify. Okay, Partho Sharathi has already 2 questions. Does the growth stocks have higher sustainable growth rate? May or may not be. May or may not be. All the growth stocks are not equally sustainable. So these will vary from one firm to another. So as I was pointing out, Polaris or RAM Informatics, perhaps, RAM Informatics and Infosys, both of these were growth stocks because they have growth opportunity. Now, whether the growth opportunity is high or low, that's different. So if a stock has growth opportunity, it's a growth stock, right? But they may have different sustainable growth rates or higher sustainable growth rates compared to the cyclical firms or like that. So I think the question is like that. So whether they will be having higher sustainable growth rate than the cyclical or the other stocks. May or may not be. Some growth stocks, some even very good, reputed old economy stocks might give you higher sustainable growth rate than the growth stocks. That is also feasible. So can we calculate the sustainable growth rate and try to justify the price earning ratio multiple? Yes, that is absolutely done. You can always find out the sustainable growth rate, or alternatively, we can find out the present value of the growth opportunity. Now, once again, that will be complicated because computing net present value is not that easy, because you will have to have different discounting factors for different types of stocks. For example, if you have the IT sector, if you have the manufacturing sector, paper sector, automobile sector, then you must have different discounting rates for the different sectors. Within each sector, once again, the discounting factors will be different. So if you just go by the textbook definition that, okay, so there is a net present value formula, we just calculate one discounting factor, let it be market, which is one type of very common mistake. If I ask my students, what is discounting factor or what is discount rate, the immediate answer is, and it's spontaneous, the market rate of interest. Now the thing is, the market rate of interest is one type of discounting rate. It is not, that is not the way to define the discounting factor. So you will have to have different discounting factors for different stocks, different sectors, and then also you can find out the growth opportunity, net present value of the growth opportunity. But if you can do that, you have many market models from where you can estimate. So you can always find out, use that market models, and you can find out the discounting factor, and you can find out the net present value of the growth opportunity. Otherwise, sustainable growth rate may be compounded, may be used, and it may be used to justify the price earning ratios. Yeah, it should be risk adjusted discounting rate, but it should reflect the risk, because that is why you should have different discounting rate for different factors. So Omkur has a different question. Omkur is saying that, would you be sharing the slides? Yes, I'll be sharing the slides. But within the slides, you don't have all the points that are being discussed. So it is just a sketch of what was being presented. So of course, I'll be sharing. Okay, any other question? Okay, Rochishnu has a question. Could you repeat the determinants of the book value? Yes, Rochishnu, there are three components rather of the book value. One is the total equity, and second one is the capital surplus, the reserves and surplus that you have, and the third one is the retained earning. So it is basically the equity side that you have apart from the treasury stock, because that is always subtracted. So it is the equity side that you have from the balance sheet. So the three things. Okay, anything else? Jishan, what is your question? Any introduction of technical and fundamental analysis? What is your exact question?
Ma'am, will you introduce introduce technical and fundamental analysis, which we study in the financial economics? In end of the towards the end of the.
It is not a technical analysis. So technical analysis means you will have to consider the prices and the different types of trading strategies, right? So you were talking about all those things. The technical analysis, the trading strategies, the different types of patterns. No, that is actually beyond the scope of this workshop. So maybe that could be arranged later on. So you were talking about basically the patterns in the stock prices, how do you find out different indicators, the leading and the lagging indicators, the cross-section and the time series momentum trading strategies, these things, right? But that is not within the purview of this workshop, because that will itself be taking 4 to 5 days to complete, right? So that's a very huge topic. And the fundamental analysis, probably you have done the other workshop that was conducted by Dr. Shashwati Mukherjee, evaluation of bonds and stocks. There you had some idea of fundamental analysis, how the fairly price could be determined for the stocks and the bonds. Have you attended that? So if you have attended that, so yeah, so probably then you have some idea about the fundamental analysis. But here I am not doing the fundamental analysis. What I am trying to emphasize is that I am trying to relate the financial sector performance of the firm with their fundamentals, with their real economic activities. Right? I'll not be talking about the fair price. Okay, any other question? Any other clarification? Okay, so if not, then we shall be meeting tomorrow once again, and that would be the last day of our workshop, where we shall be doing some practical sessions. I'll be showing you how to you may always differ from what I'll be, or rather your decision may be different from the decision that I'll be taking, but I'll be showing you my decision, and accordingly, given a data set, you will have to take your own decision, and probably that will be your assignment. Okay, so if there is no other question, then we can leave for the day. Ruchi, ma'am, is this practical on Stata or Excel? Okay, I'll be using Excel. I'll show you with the help of Excel, and I'll be using eViews also. Okay, I'll show you how to do it. It is not necessary that we shall be all doing it at the same time. So I'll be showing it how to do. If you are interested, you can do that at the same time, or you can work it in your home, and later on you may please let me know if you have any kind of problem. Okay, Ruchi has only Stata, not eViews. Okay, eViews 10 is easily downloadable from the website. So there is actually a YouTube link from where you can download eViews 10. So you just search for it, download eViews 10 free YouTube. You will be getting the link. There will be a YouTube video which will be showing you how to download it, and in the description box you will be getting the link. It is very easy, but before you could download and install it, just make your do you have any antivirus? So if you have any antivirus, so first make those antivirus inactive and then install eViews. Otherwise, it will just eat up the patch and the crack. Biplav has a question. All the softwares are available at right. Okay, that is free of cost, and the YouTube link that I am talking about is also free of cost. So Ruchi, there is another suggestion made by Biplav, so you can do either of the two things. Okay. So any other question then? If not, so we may leave now. We shall be meeting once again tomorrow. Okay, then bye everyone.